So beginning with a housing recovery theme, you'll remember in 2011, Arnold spoke in great detail about the housing market and the pace of the recovery that we saw then. We felt that the housing market was bottoming and that over the next several years that the new builds would gravitate back up to that million unit per year average that it had been at for so long. We certainly held a minority view at that time. Most analysts on Wall Street were advising investors to either avoid the industry entirely or sell their stocks. They provided us a gift once again, and we gladly accepted it, buying several housing stocks during the second half of 2011. And as this chart shows, the housing market did in fact bottom in 2011, and that recovery has gained speed. Our investments in MDC, Toll Brothers, Universal Forest Products, and Fortune Brands have all paid off quite nicely. And of course, after shunning the builder stocks in 2011, Wall Street is now back in buying them, quite giddy in fact, from the beginning of the year. Of course, that's after all these stocks have doubled, tripled, or more. The Wall Street Journal even had an article where they had a picture of a house and all the items that go into a house and suggested these are the stocks that folks ought to be buying to benefit from the recovery. This excitement, of course, pushed stocks to higher levels, so much so that it had discounted the recovery too far into the future. Those stocks hit our sell points. We sold those stocks. We still think there's legs to the housing recovery, and we continue to expect the opportunity to present itself where we can buy these same stocks back. And whenever it does, when these stocks get to our buy points, we will happily buy them again. In response to the severity of the housing crisis, the industry has seen a slew of new banking regulations. And this is causing a significant structural shift in the mortgage industry. And as a result, we see an opportunity to buy the specialty mortgage servicers. To understand this shift, however, we have to go back a little bit and look at the structure of the industry prior to these new banking regulations. This is a chart that represents the flow of a typical mortgage payment. So when a mortgage payment was made, it would go to the bank, and that bank also operated as a mortgage servicer. Now, that mortgage servicer is the administrative function of separating that mortgage payment into taxes, insurance, and principal and interest. In the old structure, the bank not only acted as the lender, but was also acting as the mortgage servicer. But thanks to these new regulations, the industry structure has now changed, such that the mortgage servicing, or that administrative function that was previously done by banks, is now being replaced by a group called specialty mortgage servicing companies. There's $10 trillion in mortgages outstanding in the United States that require servicing. This graph shows the dollar value of the mortgages that have shifted from the banks to the specialty mortgage servicing companies since the housing crisis as a result of the new regulations that have come forward. You can see in 2008, this is a standalone business, and it was virtually non-existent. Currently, there's $1.1 trillion of mortgages that are being serviced by these specialty servicers. And over the next 5 years, we expect that to move to $2 trillion, which would be about 20% of the outstanding mortgages. You can see with this transition from the previous mortgage servicers or the banks moving to the specialty mortgage servicers, those that can perform that new function should fare quite nicely over time. Well, Kenny Domeleys, our housing analyst, recognized this shift in the second half of 2012. And he spent the next several months digging through the details of this new industry. It was new. There wasn't a lot of people that knew about it. He searched out consultants and other people in the industry to find out what it involved, and it became very evident through Kenny's due diligence that there was several things that were quite important. First, the barriers of entry were quite high and difficult. Every executive in these specialty mortgage servicing companies has to be approved by regulators in every state. In fact, in a conversation with the CFO of one of these companies, he's been fingerprinted 100 times so far this year. It was also evident that the regulations were forcing the banks out of the business. They didn't necessarily want to get out of it, but they were forcing them out of the business, which meant that there were forced sellers. It also meant that those that were buying it were getting great deals. He found that there was only a handful of companies that could do it. The processing infrastructure required was quite significant, and there was not too many people that had that infrastructure in place. So what we found was that the structural winners were going to be, there wasn't many of them, and they would see significant benefits as this transition occurred. Those companies are Ocwen, NationStar, and Walter Investments. In December of 2012, we began buying NationStar, and over the next several months, we bought Ocwen and Walter. As a package, these companies are up 25%. In addition, we're tracking several other opportunities in the mortgage financing business, and we hope to add those to your portfolio, and we'll keep you posted on our progress there.